Your cloud bill just got its own ticker symbol. The world's largest derivatives exchange is turning the GPUs behind every AI app into something you can trade, and that finally puts a price tag on the compute your money quietly pays for. Here's what's happening and why it hits your wallet. On August 11th, CME Group, that's the Chicago Mercantile Exchange, announced it will launch the world's first compute futures contracts on October 5th. Together with a GPU market intelligence firm called Silicon Data, pending CFTC approval, these will list on NYMEX. This is the moment AI compute officially enters the derivatives era. Here's the key part. You are not trading graphics cards, you're trading the price of renting them. Two contracts, the Silicon Data H100 Rental Index Future and the B200 Rental Index Future, track the hourly rental cost of Nvidia's GPUs published daily by Silicon Data. Each contract covers 730 GPU hours, about one GPU running a full month, and settlement is in cash. No one ships you a chip. Why does this exist? Because GPU pricing is a mess. Supply is tight, supply chains are fragile, and the big labs hoard chips, so spot rental rates swing hard. Worse, most AI builders and cloud vendors sign private long-term leases, so two companies renting the exact same capacity can pay wildly different prices with no way to know who got the better deal. CME picked H100 and B200 for a reason. Nvidia holds roughly 80 to 90% of the AI training and inference chip market. A futures contract needs deep, liquid, frequently traded underlying assets, and these two are it. H100 is today's workhorse for training. B200 is the next generation Blackwell chip for inference and massive scale training. First job of these contracts: price discovery. They build one transparent, tradable forward curve for compute, a single benchmark the whole industry can finally price against. CME's own framing is blunt. This is about grabbing the standard and setting the price. Second job, hedging. Think of it like airlines buying fuel futures. A compute-hungry company buys futures to lock in tomorrow's rental cost, so a mid-training price spike doesn't blow up the budget. A data center operator sells futures to lock in revenue, protecting against a rent crash when a flood of new chips arrives. Both sides get peace of mind. This is bigger than two new tickers. It means compute is becoming a real commodity, like oil. Just as crude evolved from scattered spot deals into a global futures market, GPU power is being standardized into a tradable, regulated asset. And that matters. Once you can price compute forward, data center builders find it far easier to raise bank loans, bonds, even on-chain RWA financing. Now, connect the dots. Just weeks ago, we covered Nvidia teaming up with 6 Wall Street institutions to build a $500 billion AI infrastructure financing platform. That platform creates the underlying assets and the credit market. CME's compute futures are the matching layer, the public, transparent pricing and hedging tool sitting on top of that $500 billion of debt. With a tradable future in place, hedge funds can run clean plays, long the physical data center, short the compute future, capture the spread. Or they can securitize compute exposure into products retail and institutions can buy. Either way, it pulls more social capital into AI infrastructure, and it's exactly what that financing platform needs to look credible. But hold on, 3 real risks. 1 is Silicon Data's rental data actually rich, transparent, and fair? The contract's credibility rests entirely on that index. If the benchmark is shaky, the whole market is shaky. 2, if Microsoft and Amazon keep signing private OTC leases, financial capital and smaller cloud vendors get squeezed out. The futures could launch with thin liquidity, and a derivative with no liquidity is just a press release. 3, GPU generations turn over fast. H100 to B200 to Rubin. Older chips indices can depreciate quickly, which shortens each contract's useful life. Pricing a thing you can't store, that ages in months, is genuinely harder than pricing oil. Step back. This isn't isolated. CME's futures, Nvidia's financing platform, IC's own compute derivatives, it's one coordinated push to financialize AI compute. As CME puts it, compute has become the currency of the AI age. The hardware is just the start. The money is the real game. So the next time someone says AI is just chips, tell them it's now a futures market too. If this reframed how you see the AI economy, hit subscribe. Alex, out!